Welcome back, Advanced Vita volunteers. Today we are going to be discussing itemized deductions. And you might remember from previous lessons that we've covered the standard deduction. We talked about once you get to adjusted gross income, taxpayers have a choice, or most often they have a choice to deduct the standard deduction or itemized deductions, and that depends on which gets them the best benefit. So there are a few taxpayers that are required to itemize, and that includes most applicably for our clientele, people who are married filing separate and the other spouse chooses to itemize. Then our taxpayer would be required to either itemize or take a zero standard deduction. There are a few other people that are required to itemize. It might be people who are filing a short tax year because of a change in their annual accounting period, or a non-resident or dual status alien during the year. But those situations are out of scope for VITA. And if you need to look it up, there's publication 4012, tab F has this chart to remind you. So when we have taxpayers coming in with their intake form, under expenses, that's part 4 of Form 13614C, there's question 4 here, asks about certain specific expenses: medical and dental expenses, mortgage interest, taxes, and charitable contributions. And you might recognize this slide set up from our standard deduction lesson. We did just barely touch on it, of course, because it's important for all volunteers to recognize when somebody might benefit from taking itemized deductions. But this lesson, we're going to delve in a little deeper into each of these scenarios. Itemized deductions get reported on Schedule A, and you've probably seen Schedule A in some of the practice returns we've been doing. TaxSlayer has automatically been populating that return or that form, even if our taxpayers weren't going to take this itemized deduction. So you may have seen this before, and it's broken down into some large categories of the kinds of expenses, and they match what categories were on that intake form. So it starts off with medical and dental expenses, and then it goes into taxes, and then there's a section for interest and a section for gifts to charity. There are a couple of other smaller sections down at the bottom. We're not going to delve into those. For casualty and theft losses, that is only deductible if the taxpayer is living in a federally declared natural disaster area. That's not going to be applicable for any of our taxpayers, so I'm not getting into that for this lesson. And then for other itemized deductions, here again, for our taxpayers, the only one that we would need to remember is if they had gambling income, they could deduct their gambling losses here on Schedule A, and that's in that other itemized deductions section. If they aren't itemizing, remember, they cannot deduct their losses. So let's get started with our medical and dental expenses. And these are expenses that are greater than 7.5% of AGI. And I thought sometimes that's a little confusing the way that's stated when we state it in words. So it's helpful to think about, we have our AGI, multiply that by 7.5%. That is our non-deductible amount of medical and dental expenses. So then we look at what qualified medical expenses did our taxpayer have in total. and then we subtract the non-deductible amount, and if they have any left, then they will have some deductible medical expenses that we can report on Schedule A. And we need to talk about whose qualified medical and dental expenses these could be. So these expenses would be paid by the taxpayer or by the spouse if they're married filing joint, and they could be paid for the taxpayer, for the benefit of the spouse, for the benefit of any dependents that are claimed at the time that the services were provided or at the time that they were paid. They could also be paid for individuals who could be dependents except they don't meet the gross income test, they don't meet the joint return test, or the taxpayer or taxpayers in the case of married filing joint could be claimed by someone else. So there's still those support and age requirements and relationship requirements. For children of divorced or separated parents, if that child is claimed on either of the parents' return, each parent can deduct the expenses that they paid individually. So let's talk about some common deductible medical and dental expenses. And we touched on this a little bit when we were talking about health savings accounts. Publication 502 gives a great list that's much more inclusive and detailed about what kinds of expenses are deductible. But just kind of an overview of some of the common ones that you might see are doctor's fees, dentist fees, hospital fees, and that includes inpatient meals. Meals otherwise don't count. Prescription medication and insulin, and eyeglasses and contacts, hearing aids, long-term care accounts, smoking cessation programs, laboratory fees, reproductive care, which can include like in vitro fertilization, it can include sterilization, pregnancy tests. Therapy also counts, so regardless of whether it's physical therapy or mental health therapy, as long as it's considered medically necessary, it's something that can be deducted. And insurance premiums, but insurance premiums are a little tricky, and so we're going to talk more about those. So we're going to start off with what insurance premiums are not deductible, because frankly, most often they are not deductible. So insurance premiums that are paid through an employer-sponsored plan, usually these are the ones that are reported on the W-2, box 12 with a code DD. They were paid with pre-tax dollars, and we've talked a lot about, you know, how we have some differences in the income reported in box 1 versus the income that's reported in box 3 and 5 of the W-2, and how box 1 is often lower because certain amounts are taken out of that income that is reported for income tax. And so employer-sponsored health coverage is one of those instances. So generally, if people are getting insurance through their workplace, they cannot deduct the premiums from their income on Schedule A, because that would be giving them a double tax benefit. Also, premiums that were paid with tax-free distributions or were covered under premium tax credit. These taxpayers were getting a special credit, which we'll be talking about next week. They've already had a tax benefit, and so they can't double up on that by deducting the same expenses on Schedule A. Life insurance is not permitted to be deducted as this health insurance. It's specifically health and dental kinds of insurance. Also, insurance that covers lost earnings while somebody's ill doesn't count, and the medical portion of car insurance doesn't count. So the types of insurance premiums that are deductible, if we are presuming that the taxpayer has not already received a tax benefit for these premiums that they're paying, could be Medicare Parts B and D, which are reported right on the 1099 SSA, and we just enter them into the 1099 SSA entry screen in TaxSlayer, and TaxSlayer automatically carries this over to Schedule A for us. And I always enter those regardless of whether the taxpayer is itemizing or not. It's just a good habit to be in. It could be premiums for medical insurance, dental insurance, vision insurance, and it could also be for long-term care insurance, but I put a little star by that. If you have a situation where somebody is wanting to deduct some long-term care insurance premiums, you really need to head on over to Publication 502 and look at the limitations for that. So let's talk about some of the expenses that are specifically listed as not deductible. So controlled substances that are not legal under federal law. And so the big one for our state and our area generally is marijuana. It's legal under state law, but it is not legal under federal law, which means that it cannot be deducted on the federal tax return. Cosmetic surgery is also not deductible. Gym and club memberships are not deductible, and weight loss programs, unless it's for the treatment of a specific disease. So if the doctor, diagnosed a specific disease and essentially prescribed a weight loss program to an individual, it could be deductible. But generally speaking, if it's for, general health, or if it's for appearance purposes, it's not deductible. Over-the-counter medications and vitamins are not deductible. And this is a little bit of a departure from our HSA expenses. Remember, HSA, we could use HSA funds to purchase things like allergy medications, but that's not the case for deducting medical expenses on Schedule A. And then also personal use items such as toothpaste is not deductible. And then you can't double up the expenses that you paid through an HSA or an FSA and then also deduct the same expenses on Schedule A. If you got a tax-free benefit from it before, you can't get another tax benefit for it now. And then any expenses that were reimbursed. So for instance, if when people get their medical bills and it shows that the insurance paid for part of it, and then there's the part that the taxpayer is responsible for, they can only deduct the part that they were responsible for. They can't deduct the part that the insurance paid, or if they were reimbursed in any other way, they can't deduct anything that was reimbursed already. So now we can start talking about our second section of the Schedule A for deductible taxes. And for taxes to be deductible, the first overarching concept that we have to start out with is that the tax has to have been imposed on and paid by the taxpayer during the tax year that we're looking at. So they can't be deducting taxes that they're paying ahead, and they can't be deducting taxes that they aren't required to pay. So the first type of taxes that are deductible are state and local taxes. And for this, taxpayers have a choice. They could choose to deduct the state and local income tax, or they could choose to deduct the state and local sales tax. Whichever they choose, they will be limited to $10,000. And of course, in the state of Washington, we don't have income tax, So any of our taxpayers that would be looking at itemizing would be deducting the state sales tax. And with state sales tax, our taxpayers have some more options. They could choose to deduct their actual sales tax. And so they would have been saving up all their receipts from over the course of the year and adding together all of their sales taxes. This is a little bit impractical. So, and taxpayers have never done this, even those that are savers. I rarely find anybody's actually saved up all of their receipts. So usually what we end up working with is there's a worksheet in TaxSlayer. When you go into the taxes section, it says state sales tax worksheet, and you click on it, and it asks for the taxpayer's zip code, how many days they lived in the zip code, and then there are a couple fields for tax rates based on the state tax rate and the local tax rate. You don't need to touch those. Those are only for overrides. It does a great job of looking up our state sales tax rate of 6.5% and our local tax rate of 1.9%. And so people get their 8.4%. But you don't have to enter those percentages in. TaxSlayer looks them up. It's important to note, though, that if our taxpayers bought any significant items, such as a vehicle or a boat, then they could save the receipt or the information from that large ticket item, and that can be added into the calculation that TaxSlayer puts for, general sales, the general sales tax deduction based on where they live. There's also a field to do that at the bottom of that entry screen on the worksheet. Or another option is to use the calculator at irs.gov. Sometimes this is good to show taxpayers so that they can look this up later if they're wanting to do some tax planning for the next year. The web address is there on the bottom of the slide, and you can see what the screen looks like. Another type of tax that is deductible is real estate tax. And often these are reported on a 1090, well, they're not on the 1098 mortgage interest form anymore. They're reported with it, which usually this form, it very often comes in what looks like a letter form, and then it has some box, some columns with box numbers, like some of our other forms that come looking like letters. And usually the real estate taxes are reported somewhere on that letter. If the taxpayer paid real estate taxes but they didn't have a mortgage, or they chose to pay their own real estate taxes and didn't have the mortgage company keep that in escrow for them and pay it, we can always help the taxpayers look up on Clark GIS if they live in Clark County. You can look up their address and they can view their tax summaries. It's also important to note, in large part for education for some of our taxpayers, the taxes for local benefits and improvements that tend to increase the value of the property are not deductible. So these are like the recurring taxes that we pay every year. Sometimes people will have been required to hook up to, the city water or the sewer system, and they'll have like a huge fee that they've been charged, and they'll feel very passionately that they should be able to deduct that, and we have to kindly educate them that they don't get to deduct that right now. And as we've talked about in our capital gains lesson, what happens is that that cost, that assessment, gets added into the cost of their home. So then when they sell their home, it lowers the profit of their home that they will have to report for taxes, or it adjusts their basis. And then personal property taxes can be deductible if they are based on the value of the property and they are imposed on a yearly basis. However, this is not applicable for Washington State. A lot of times people will want to deduct their tabs for their car, or those kinds of taxes, and those are not the right kind of tax for the personal property tax. So this is another one that we sometimes find ourselves educating our taxpayers on, that in Washington State, the property taxes that you're paying for anything other than real estate are not based on the value of the property, and they're not imposed on a yearly basis, and so they are not deductible on Schedule A. So then we can talk about what are not deductible taxes. And some of these are not deductible taxes, and some of them are not taxes. So employment taxes are not deductible on Schedule A ever. Our employees don't get to deduct their Medicare and Social Security taxes. And for self-employed individuals, remember, they get a deduction, but it doesn't flow through Schedule A. The self-employed person's deduction gets taken as an adjustment. It's a before the line, before AGI adjustment. And then federal income taxes are not deductible. License fees, so things like your driver's license, those aren't considered taxes. And then foreign property taxes are not deductible on Schedule A. They might be deductible for some taxpayers as business expenses, but that's going to be out of scope for VITA anyway, and it's unusual circumstances. Moving on to deductible interest, we have three types of interest that could be deducted on Schedule A. Home mortgage interest, points, as long as they are paid as a form of interest, or accelerated interest, and investment interest. And investment interest is out of scope for VITA. Home mortgage interest is deductible, but there are some limitations to how much of a mortgage may be deductible, or depending on what the mortgage was used to pay for. So first of all, the loan has to be secured by the taxpayer's home, but also the proceeds have to be used specifically to either build or buy or substantially improve that property. So if people are taking out mortgages above the value of the home and going on vacation, or they're paying tuition, or any number of other things, paying off credit card debt, they can't deduct the amount of interest that is applicable towards what didn't cover the home itself or improvements to the home. And that would be the taxpayer's qualified residence. So when clients come in and it looks like they're going to be itemizing, and home mortgage interest is part of that, one of the first questions we need to be asking them is, was this entire amount of the loan used to acquire this home, or to build it, or to purchase it? And if they say yes, we're good to go, all of that interest should be deductible. But if they say no, they used some of it for the home, and they cashed out a little bit for paying off their student loans, or anything else that's not either for the home or an improvement to the home, then we might need to do an allocation where you allocate the portion of interest that applies to the debt for the home can be deducted, and the portion of the interest that applies to the portion of the loan that was used on those other things and not deduct that. And so this is something that when that's the case, you'll want to look up in publication 936. You can see that there are some flow charts involved in that publication and some worksheets to help you determine if and how much mortgage interest could be deducted on this taxpayer's Schedule A. And generally speaking, mortgage interest is going to be reported to the taxpayer on this Form 1098 mortgage interest statement. And I think, as I mentioned when we were talking about the taxes, a lot of times this one will come looking more like a letter with maybe some columns or rows that correspond to these box numbers. It'll tell you what box number it is. And sometimes you'll see those taxes paid also on that letter. So you might see this in a number of different forms. But this is a Form 1098 mortgage interest. And you can see box 1 is where the mortgage interest that the lender received is reported. And then if we move down to box 6, you'll see that that's where points are reported. And it says, points paid on the purchase of a principal residence. So there are some details that we need to talk about in regard to points. And again, these are points paid as a form of interest that are deductible. So if the taxpayer just bought or built their main home in the last tax year, then they may be able to deduct the entire amount of points that they paid in that year. However, sometimes, homeowners refinance and it's not for a new home, they're just closing out the old loan and getting a new loan. And if that's the case and they pay some points in order to lower their interest rate, then those points, when we report them on the tax return, we have to spread out the deduction over the life of the loan. So they can't take out the full amount of points that they paid in that year on the current year tax return. They'll have to spread it out. They take the total amount of points paid, the life of the loan, how long are they going to have this loan for, divide the points they paid by that life, and that is the amount that they get to take in the current year. And it's important to note that not everything that is called points is considered points paid as a form of interest. So points that are non-deductible might be appraisal fees, preparation fees, VA funding fees, or notary fees. Those kinds of things might not or won't be deductible, and so we might need to ask our taxpayers a little bit about, these points. Were they to lower your interest rate, or were they including some of these other fees? And then we have some things that aren't deductible as interest on Schedule A. So interest on a personal car loan is not deductible. Any other kinds of personal loans are not deductible. Credit investigation fees or loan fees for services needed to get the loan, those are not deductible on Schedule A. If there are for services needed to get the loan, they might be something that adds to the basis, adds to the taxpayer's cost in the home. And then interest on debt that the taxpayer is not legally obligated to pay, which seems like a weird thing to have a note about. but sometimes, for instance, a kindly relative offers to pay off the student loan debt for a nephew or niece, in which case that relative would not be able to deduct the interest that they're paying on that kind of an arrangement, because they are not legally obligated to pay that loan. It's the nephew or niece that's legally obligated. They're essentially just giving their nephew or niece a gift, so it's not deductible. And then finance charges for non-business credit card purchases. So you can't write off the interest that you pay on your personal credit cards. Next, we'll start talking about charitable contributions. And first, we're going to define what qualified organizations are. So taxpayers can only deduct charitable contributions given to qualified organizations, not individuals. So a qualified organization might be an organization that operates exclusively for religious purposes, charitable or educational, scientific or literary purposes. Organizations that work to prevent cruelty to children or animals, or if they foster national or international amateur sports competition, as long as they are not providing, making money providing athletic facilities or equipment. War veterans organizations are qualified. Certain nonprofit cemetery companies or corporations are qualified. And then various governments and governmental agencies could be qualified organizations. So, the United States, any state, the District of Columbia, a U.S. possession, or an Indian tribal government are organizations that could be qualified as for charitable contributions, so long as those contributions are charitable and not taxes or something else. And then the note about it can't be individuals. This applies to any sites that are doing fundraising on behalf of certain people or groups of people. You can't deduct monies that you have donated to or for a specific individual. Charitable contributions can be made in the form of a monetary donation. They could also be non-monetary, so used clothing and furniture and other items, so long as they're in good condition. You can deduct the fair market value of those. So there's something called the thrift store value. If you're donating to a thrift store that's considered a charitable organization, then you use what's called the thrift store value to determine how much can be deducted. And then unreimbursed transportation expenses, there's a standard mileage rate that can be taken based on charitable contributions. It's different, much lower than the business mileage rate. But if somebody has significant mileage that they're traveling, it might be certainly worth putting in there the mileage. And then any part of a contribution above the fair market value for items or benefits received. So a lot of times various organizations will say, hey, if you donate this much money, you'll get this free gift in return. So you have to subtract the value of that gift from the total contribution to come to the deductible portion. So organizations that are not qualified for the purposes of this deduction are business organizations like the Chamber of Commerce, civic leagues and associations, political organizations and candidates, social clubs, foreign organizations, homeowners associations, and communist organizations. So, and then we need to talk about certain kinds of contributions that are not deductible. So these are things that even if they are given to a qualifying organization, they still cannot be deducted. So the cost of raffle, bingo, or lottery tickets, tuition, which comes into play where taxpayers are sending their children to a private school, and they're making, donations to this school. It's a nonprofit. If it's for tuition, that's not deductible. And then the value of a person's time or service. So in this example, say that the taxpayer is a tax professional and they donate their time providing tax services. Well, they can't say my time is worth this much, and so I'm going to deduct this much on my Schedule A. That doesn't count. So also blood donated to a blood bank or the Red Cross. And then while you can take mileage, you cannot take car depreciation, insurance, general repairs, or maintenance as a deduction on Schedule A. And then there are certain limitations on charitable contributions. These really don't come into play a lot for our clients that we'll be seeing, but it's good to be aware of them just in case. So taxpayers whose charitable contributions are more than 20% of their adjusted gross income, they may only be able to deduct a certain percentage of those contributions, and then they carry over the remaining contribution for a later tax year. And that percentage really varies depending on the type of gift and the type of charitable organization. So if you run into this situation, definitely be looking it up in publication 526. And then, as we've talked about before, we don't have to audit our taxpayers. We don't have to see every scrap of paper or documentation. We can rely on what they have told us, so long as they're not giving us conflicting information or information that's just, not believable. Like you can't see how this could possibly be true, or it seems unlikely to be true. So taxpayers, they don't have to bring in their proof that they've made these expenses or they've given these charitable contributions. But we do need to make sure that they are aware, because if the IRS ever came back and asked, that they would want to see this documentation. So documentation that works to prove charitable contributions are things like credit card or bank statements, canceled checks. If the taxpayer made a monetary contribution that was more than $250, then they need to have a statement from the charity. And I think you see this a lot with church donations. Some taxpayers pay tithes, and so they'll have given a significant amount of money to their church, and they just need to make sure that they have a statement from their church verifying that they made those contributions. And then if they are giving non-cash contributions of less than $250, they need a receipt from the organization, and then the taxpayer can make a listing of all the items that they donated along with their fair market value. If the single contribution was $250 to $500, then they're going to need not just the receipt and the listing, they're also going to need a statement from that organization saying that they didn't receive anything in return for that donation. And then if they are giving non-cash contributions of $500 or more, there's a form where things have to be listed out, and that is out of scope for the VITA program. So now that we've gone in depth into itemized deductions and Schedule A, we talked about deductible medical and dental expenses and taxes and mortgage interest, including mortgage interest, and we talked about charitable contributions. Here's what I want you to do. Head on over to Lincoln Learn. and answer the skill check questions. There's just 3 of them. If you are in Accounting 496, instead of doing that, you do have a 10-question quiz associated with this in Canvas. And then we have a return with some itemized deductions to practice entering into TaxSlayer. And as always, remember your resources, publication 4012, publication 4491, and for this lesson we had publications 502, 526, and 936 that can give us a little more detail about what particular kinds of things might be deductible if we have any situations where something might be on the line, or we're looking at needing to allocate an expense as partially deductible or partially not. So those are always available during training, during your open book exams, and absolutely they are available to you when you are in the field.